Hey guys, with the recent panic at the gas pumps and all the cries for outrageous inflation, I decided to do another different kind of video to look at the overall market. I did a video on the housing market a few weeks ago, and you can't really analyze that directly with Elliott waves, but you can with gasoline. So I'm going to be covering RBOB, which is a gasoline futures product, which I'm going to touch on in just a second, which does actually follow Elliott Wave Theory. And we're going to look at the history, what my primary expectations are, and some long-term outlooks, just to give you guys an idea how to strategize for yourself to protect yourself and how to adjust your own habits in order to protect yourself against potentially higher energy prices in the future. So without any further delay, this is obviously an Investopedia article. I just wanted to bring this up just so I could read what the ticker actually stands for, the acronym Reformulated Blend Stock for Oxygen Blending. It's one of the components used to create reformulated gasoline, one of the many components. There's a lot of other details here about how this futures product works, but the bottom line is that its price is actually relatively close to what we see at the what we see at our gas pumps locally. And in recent history, we've actually been seeing about a 70-cent difference between the ticker and what we're actually paying at the pumps. Now, obviously, there's some regional differences. So that means that possibly your state and local taxes, seasonality, or even weather events like hurricanes knocking out refinery capacity or supply chain constraints, or even panic can cause some pretty big abrupt changes in the gas price in your locale. But it's no surprise that this is quite a shock to most of us because we've been enjoying pretty cheap gas prices for a while. We hit a multi-decade low in March of 2020 for gasoline, and the same thing with oil. If you guys remember, we had the USO, I guess technically it's an ETF. It blew up because we had a big drop in the oil price, and they had to restructure it and a bunch of other stuff to keep it alive. And I remember I ate it on some calls I bought when I was trying to buy the dip. Now, in the long term, I'm actually going to shift to the long-term weekly chart here. This is, again, RBOB. You can see that, this thing goes all the way back in the 80s. We had a nice upswing. Nice is relative. There was a bit of a panic. If you guys remember cash for clunkers, a lot of people are dumping their big trucks and SUVs because there's a big, there's a climax in the prices, big interest, rising revival of small cars, and then everything went down again. And ever since then, we've been in a 15-plus year bear market in gasoline. Oil kind of is correlated to it as well, but this is literally a multi-decade low. This is the lowest we've had our gas prices fall in March of 2020 since the end of the 90s. So 1998, December 1998. And ever since then, you can see that we have a clear impulsive spike. So the long-term pattern is a little tricky to analyze. We have charts for oil and other commodities. This chart doesn't go back quite as far, and the structure is a little tricky, but there's much more clarity on the shorter time scale. This is, again, the bottom that we had in March of 2020, and we have what looks like it's falling pretty clean, impulsive Elliott wave patterns. So I also, before I go any further into the detail, there are some effects of seasonality potential. I know people want to always credit traveling or the lack of travel with ups and downs in the price of gasoline. And there's a correlation. Is that really the cause? Don't know. You can believe what you want to believe, but we're going to go with our impulsive primary pattern first. And I say impulsive because the alternate pattern is not an impulse. That's the green. We'll go over that in just a second. But we had everything crash in March of 2020. We have a 5-wave impulse that topped around $1.39, August 25th. And then we had a second wave. This aligns very closely with what we've seen in the Dow Jones and various other asset classes, where we had a clear zigzag pattern for a second wave. And based on this, we can build a larger pattern. And you can see how we just skyrocketed from there. We got up to 223. I'm calling that the subwave 1 of our larger wave 3 because we hit the 0.61 extension. We would expect the third of our third to get to the 1.236. So this is a key number because this is the next fib that we're going to attack. That sits at 509, 508, 509, right in that range. And I would expect us to top there. If we keep going, very likely we're going to go straight to the 1.32 extension, which means that would be the major third, not the third of the third. That's just not something we're going to focus too much on at the moment. But point is that's about, I think, 22% from where we are right now, sitting at 417, 509. I know I've been seeing prices around 470, 480 here in Texas. I know if you're on the coast, you're paying a bit more. But again, it's a rough estimate. At last check, the national average as of today, June 10th, was $4.98 a gallon. So that 70 cents rule still seems to hold. That's about 417. So 70 cents above, that's about 487. So let's give or take 80 cents. You could see this, you're going to be paying dearly at the pump. We could see our national average getting close to $6 or even eclipsing it relatively soon. And I even have a timing peak here. So again, we have some channel trend lines, and it's looking like August of 2022, maybe middle of August would be the peak. And again, that is a strong Fibonacci resistance. There's confluence on the bigger degree extension as well as the smaller degree, if we assume that's a 1 and that's a 2. So very strong Fibonacci resistance expected to hit there. And like commodities, you often see a pullback, a spike and a pullback. We actually saw that earlier this year in the spring. Oil had a very strong pullback after a blow off top, and I'm calling that the third of the third potentially. Otherwise, that will be the third. So honestly, this could be the third of the third of the third. I'm not going to go that far into the weeds at the moment, but that's what we're looking at right now. We'd expect a consolidation for our fourth wave. Remember, fourth waves are generally long and slow and grindy. So while here, our second wave, we had a very short-lived second wave here. Was that about 2 months maybe? August to the end of, to early November, 2 months there. This was a long second wave. It really depends on where you consider the top of the first wave to actually be. It could have been here. There's a few different interpretations. I'm just interpreting this peak as the actual first wave. But regardless, relatively short-lived. We could see a bit more length on this fourth wave consolidation. I know I have this fourth wave marked relatively soon in September, but this could go well into the winter and beyond. As a matter of fact, I actually moved this over just to reflect that it would be expected to be a longer, more drawn-out event, possibly back down to below 371, maybe as far down as the 271 mark. Remember, add 70, 80 cents to that to get your national average gas price. So that is what we'd expect. And of course, the news will be claiming that's because we're not traveling as much and all that stuff. Eventually, expect to see a rally continuation after the winter ends. So again, we don't know exactly what the fourth wave would end. I would not be surprised if this actually took even longer than what I'm showing here, but I'm going to leave that as is just for now. Our next major top, again, would be the fifth wave of the bigger third wave. That would take us potentially, based on the internal Fibonacci's, as much as 850. So yeah, let that sink in for a moment. If we hit the 1.226 extension and pull back, our next target up would be 850, which is unfathomable. If you're an American, I don't know if we've seen gas prices like that. I know we had some scares in the 70s and 80s when inflation adjusted how much we were paying. We were paying about that much, if I'm recalling correctly. Maybe somebody can correct me in the comment section. So this will very likely coincide with the start of the traveling season in 2023. So think about spring break around that time, March, April, May, and we could see that continue into the summer. And then if this pattern is holding, we should see a major fourth wave, major as in like a larger degree fourth wave, just as that would be a larger degree third wave. And could see quite a consolidation here. Expect that to come back down to about where the small degree fourth wave was, maybe go a bit deeper. And of course, there's going to be the news telling you that people are traveling less, they're driving less, airlines are overpriced, so no one wants to go anywhere. They're going to have lots of explanations, a lot of mental gymnastics to explain why this is happening, when in truth, you don't really know. This is how sentiment works. And finally, we would see a final spike up, and that could take us between 1033 and 1417, which again is eye-watering to think. So I was saying that you want to add about 80 cents to whatever that price is. Who knows? Maybe it's not linear. Maybe you'll have to add $1 or $1.20 to that, but that would be a major top, and that would be the final top of our larger pattern from the March 2020 bottom. And well, that would be a lot to swallow there. It's probably going to be quite a panic if we're facing $14 gasoline. That's going to be nuts. Now, the alternate pattern is actually quite likely, and that's the green pattern to seize this whole thing as a diagonal. And the reason for this is when we zoom up on our first wave here, this is actually quite well identified as a three-wave structure. So a 1, 2, 3, there's not really much of a fifth wave, so it's really an A, B, C. If that's the case, we have an A, B, C down for the second wave, and assuming we hit this Fibonacci again, the 509 mark for our third wave, that would be convincingly a zigzag pattern for the third wave. So you could consider that maybe an A, B, and a C. 1.236 is a common extension for the third wave of a diagonal pattern, so it would be very textbook standard if we top right there. And if that's the case, we would expect our gas price to drop like a rock, because in a diagonal, you will often see the fourth wave drop dramatically. As a matter of fact, the textbook diagonal pattern calls for the fourth wave bottom to overlap the top of our first wave. So our first wave top was right around $1.45. You could see this thing getting back down there. So you could see your gas pump numbers get down below $2 in the winter if we really are following the diagonal pattern. So look out for that. That'll be very interesting to see. And can't imagine the excuses the news is going to come up to blame that one. Maybe the Russian war will end or something like that. We didn't have as many hurricanes, there's more production capacity, something like that. Who knows what will tell us? And the final fifth wave would be spectacular because, again, diagonals have a lot of whipsaw. So if we pull back that hard, expect a blow-off top that would hit possibly $10 or more. And especially with the diagonal, you'll often have a throwover in which your fifth wave exceeds the top of the channel trend line. So that could be an absolute panic blow-off top over there. You might start seeing people dumping their big SUVs and trucks and ponds and stuff, trying to get insurance payouts. Who knows what you're going to see in that mania right before the pullback. So what happens longer term? Is that the end of the world? Is gasoline going to be too expensive? Are you not going to be able to afford to drive anymore? Not so fast. Remember, it always feels like things are going to go up forever when they're going up. That's what momentum is. That's how sentiment is. But everything is cyclical. That's what Elliott Wave Theory is based on. So I do believe that this was a multi-decade low and that we're going to be in a multi-decade bull market for not just gasoline, not just oil, but commodities overall. We're seeing the same thing in wood and metals, uranium, if you follow my videos on that, other commodities as well. So expect this top to possibly somewhat coincide with the major stock market top. That's going to be basically an everything top. So I've been hinting at on a lot of my other channels that the stock market, cryptos, and possibly oil, etc., going to hit a major top there. And well, here's the difference between commodities and the stock market. Whereas we'll probably be entering a very long bear market in stocks and cryptos, energy, expect a second wave. So it could be a big collapse. And you know what's going to happen with the news? They're going to tell you that, oh, everyone's getting laid off, companies are shutting down. That's why no one's driving. That's why the gas prices are dropping. Sure, maybe that's why, but expect a nice reprieve from nasty gas prices at least for maybe a year or two. We'll see, because this whole rally could be a whole three-year-long rally. So you could have some relief for about a year or two. Once that happens, again, we're going to be entering a long-term commodity bull market, third wave. So that means that after the first wave and the second wave, you're going to expect a third wave. I'm not going to calculate where this could end up taking us longer term. Again, we have several years to figure this out. I know that the gas prices are expensive. It still hasn't been enough to dramatically impact most people's lives yet, but that could change pretty soon. So it's actually a good time to start strategizing. So maybe find a way to reduce your commute distances. That's one thing you can do. If you're looking to replace your car, maybe avoid the conventional gasoline powered car, go with a hybrid or something. I know everyone's about electric cars right now, but remember, this is there's an upswing in everything, not just oil. So sure, you might have your electricity being generated by natural gas like here in Texas, or oil or coal or whatever, but we're seeing a lot of bullish developments across commodities. So even your electricity will likely go up in price. So reduction would be your best way to kind of mitigate those the pain of energy price inflation. But yeah, buying more fuel efficient cars is a good way to do it. Find ways to reduce your energy consumption in your home with your appliances, and just sit tight. Again, don't panic, because these things don't go up continuously and forever. You'll have some time, but the time to start strategizing is right now, because everything is showing that those ridiculous gas prices could be, well, I wouldn't say guaranteed, but they might be much more realistic than you thought. It's not just alarmism. If anything changes, we'll be looking at that, but I'll be revisiting this chart periodically. I just want to share some insight, because I was looking at this chart the other day. I found it very fascinating, and I know it'll be affecting my own strategy with whatever car I replace my current one with, as well as future commuting, things like that. So love to hear from you guys. What are you guys seeing in your locales? Are you seeing even any kind of price gouging? Any changes you're making? What else would you like to see? There are other asset classes I can track, because Elliott Wave Theory applies to pretty much anything that's big enough. It's all about sentiment. So if you enjoyed my video, don't forget to give me a like. And if you want to keep seeing this kind of content, subscribe. Till next time, thank you for watching, and happy prepping.